All right. Welcome, everyone. Excited to have you here today. This is going to be I really think it's going to be a great webinar because we're going to cover some pretty deep, but also very detailed ideas around mutual funds and investing. And I know most of you probably have had a little bit of investing. So, quick way of introduction. Make sure that everyone knows who I am. First of all, I'm Jake Rushton. I run the 401k division for True North. We also have today Sam Watkins, who's our Chief Investment Officer. So we brought in really a lot of thoughts to share with you today. Hopefully you're familiar now with Zoom. If you have questions, you can always put a chat, put that in there if you don't want to ask it, over the video. We're going to record this as well, so you'll be able to go back and review it if you need to or share it with others. We're going to keep it as quick as we can, try to keep it under a half hour, maybe even sooner than that, just so that we can get back to your day. But we also have some slides to share. So we're going to get started. Looks like a few people are joining right now, and I'll keep adding them to there. So if you do have a question, you can always jump on the chat. And I want to pull Sam on here as well, so everyone get to know Sam. And I'm going to pull up our presentation too. There's Sam. Welcome, Sam. So real quick, I want to just make it clear, the idea of sharing this concept of understanding mutual funds kind of stems from the idea that most 401ks, this is the investment you can pick from. Obviously, a lot of you may have investments outside of your 401k, and in those, you probably have some mutual funds, I would guess. And when you really dive into the details of what a mutual fund is and what it's made of, what it's comprised of, how it is operating, it's kind of exciting because it becomes very real. You actually can see companies and understand companies that you're a part of, meaning you shop there or you buy things from them. And so mutual funds often are a little bit removed from that. And so I like to make it real. So today we're going to just dive into mutual funds, what they are, and give you some good understanding. Sam, do you want to kick it off and jump into the presentation? Oh, you're muted.
Glad to be here, everyone. Thanks for having me. And please feel free to submit questions. I think you can do that through the chat. Is that right, Jake?
Yeah, chat, or if you want to jump in and ask it in person, that's fine too. We're good with both.
It all works. So please feel free to give me any questions you want. Mutual funds are an important vehicle for any investor typically, and there's a lot of misconceptions about what mutual funds are and what they aren't. And so we're going to hopefully dispel some of those and dive deeper into how to best choose mutual funds as an investment. And it first starts with understanding the difference between an investment product and actual investments. So let's go to the next slide, Jake. And there's really two forms of investing. You can either own things or you can lend to others who own things. So when we talk about owning things, these are businesses, these are assets, something that has intrinsic value or produces something that has intrinsic value. So those are the only two forms of investing. Colloquially, those are known as, ownership is known as equity or stocks, and lending is known as fixed income or bonds, although there's more iterations of those. But everyone already experiences all of this. When you're a homeowner, that's equity. You have equity in your home, that's ownership. When you deposit money in the bank, you're technically a lender. You're lending money to the bank, and they're then lending that money out to others. And so we already have exposure to all of this. But there are lots of iterations, and it's important to know how this applies to your retirement accounts. So the next slide just breaks down the different types of ownership. You can have publicly traded stock. Jake, it's black. I don't know. At least on mine, which is totally fine. So different types of ownership include like publicly and privately traded stock, REITs, individual properties, small businesses, lots of different options there. With the lending, you lend oftentimes to governments, to corporations, to municipalities, states and local governments. There's lots of different forms of lending. And these are all different investments, okay? So these are ultimately what has value, what is creating income and growth for you. And these are the things that are held within investment products, of which mutual funds is one. Mutual investment products, so skip a couple slides, Jake.
I'm going to go.
Go one more. Yeah. So investment products, as it says, they exist to basically combine different individual investments of whether it's ownership, lending, stocks, bonds, whatever. And so you're creating efficiencies of scale by combining all these, or synergies of one management style. For whatever reason, combining all these has some advantage over owning them all individually. So what are these investment products that we can invest in?
Well, and real quick, Sam, I want to pause you right there. So
yeah, please.
What I think is interesting is Wall Street does a good job of packaging up different products. And so when you say products, when you really strip a product down, you're seeing it's either a stock or a bond. I mean, that's ultimately the only ways you can invest are those two different components of a product. And so how you buy those is where a mutual fund is just one of those products. And that's why there's a reason behind why we use mutual funds, because they're one of the most transparent, but also a great way to get diversification with a smaller amount of money. But we'll get into that.
Exactly. So here's just a list of common investment products. Mutual funds at the top has the largest market value. ETFs are another big one, and then there's a bunch of other ones, and there's many more with increasing complexity typically as you get into more of the niche products. But investment products typically aren't restricted by asset classes. And so I hear sometimes an advisor, someone come in and say, oh, they're having me invested in mutual funds and they're so expensive, or they're too aggressive. And none of these are restricted by really strategy or by asset class, but they're each one has its own nuances, but they can all contain virtually any underlying security. And so it's important to keep separate in your minds the underlying investments from the investment products, and each of those have their own complexities and advantages and disadvantages. So today we're going to dive down into mutual funds. What are the advantages and disadvantages of mutual funds? Why are they the primary vehicle within 401ks and retirement plans? And for many people, it's the go-to investment vehicle for all of their long-term savings. So let's talk about the structure of mutual funds, why they exist, and some of their advantages. So go to the next slide. Jake kind of breaks down some of these. Mutual funds have been around for a long time, since the 30s and 40s. They really existed. They were brought into existence because they provided a much cheaper way to provide broad diversification. So imagine you're back in the 30s and you're trying to get diversification across the U.S. economy, but each trade costs you several dollars. In today's dollars, you're looking at $10 to $25 a trade, depending on, and a lot of places recently have gone to free. But back then, trades were a significant expense with investing. And with a mutual fund, instead of your money just placing that trade, you can place that same trade with hundreds or thousands of people's money. And so it's a much smaller, the expense becomes a much smaller percent. It was also brought into about so that you could have one person's investment methodology applied to many people. So if you have one person who is good at this, you could have them manage a whole bunch of other people's money for a lot less expense. So basically you could access greater diversification a lot more efficiently. And to this day, they're still some of the most transparent and efficient investment products out there. And because they're so transparent and so entrenched in kind of how financial investment systems work, they are still the primary investment vehicle within 401ks and other retirement plans. Jake, if you go to the next slide, it's important to reiterate that mutual funds can be any asset class, any investment style. They can be cheap or expensive, active or passive. It's just the packaging around these individual securities. And so some people incorrectly have this bias against mutual funds because of a certain experiences in being too expensive or too aggressive or whatever these things are. But mutual funds can invest in virtually anything. So what are the specific things that we need to look for within a mutual fund that help us pick the better ones? So on the next slide, Jake.
One is real quick. Yeah, before we dive into this, there's a question which looks like we'll answer that. But someone asked the question, what are the hidden fees we don't see? So we'll talk about that, because that's something that I've been a part of understanding better from behind the scenes. I spent some time at Goldman Sachs and really helped do some of the trades. So there are definitely fees inside of a mutual fund, and understanding those and what you look out for is really critical. But going back even one step, what you were just talking about, I think the thing to make sure we understand on asset classes is that stocks and bonds both have high risk and low risk. So you, just because it's a bond doesn't mean it's low risk. Just because it's stock doesn't mean it's high risk. You can have a range of risk on both sides of that, those different asset classes. So sometimes people get confused by that and think, well, I put bonds because I'm retiring and need to be safe. It's not really the best approach. You understand what kind of bonds and how much risk those bonds really have associated with them.
Yeah. Right on, Jake. And so what are we looking for with mutual funds? What makes a good mutual fund? Because there's plenty of good ones, lots and lots of bad ones. And let's talk about those hidden fees that Jake brought up. Every mutual fund will have an underlying expense ratio is what it's called. That's the cost of running the fund, and it's in the percentage of the assets. So they'll collect, and they can range from, actually Fidelity has some technically zero, the kind of loss leader index funds, mutual funds that are literally cost nothing, all the way up to, I've seen some in the 3-4 percentage point territory just in the expense ratio. Lower is always going to be better with fees, within reason. Now the best mutual funds, that's it. And all the mutual funds that we use and we put in retirement plans, that's the only fee that you'll see. But lots of mutual funds have more fees. One's what's called a 12B1 fee. It's technically an advertising expense, and firms are limited to how high they can put those. But functionally, that's a kickback to the advisor. So if there's a 12B1 fee, that's a portion of how the advisor is getting paid. And you can just look that up. You just Google the fund, and it on Morningstar or Yahoo Finance will outline if there's a 12B1 fee or not. And they're still fairly common in today's world. The worst, though, are called front and back end loads. Oftentimes you'll see A shares or B shares. Those are loaded fund, fee loaded mutual funds. A front end loan means you're paying basically a commission again to the advisor of several percentage points. Very common front end load can be from 3 to 5 percentage points. That basically just a kickback to the advisor as a compensation for selling the fund, and you pay that right when you get in. The back end load is when you get out, you pay that fee. You never, ever, ever have to pay a front or back end load, and you should never. If you are, then you're working through the wrong advisor and you're paying way too much, because you can get the exact same, because every mutual fund has a non-loaded version of it, virtually. And so
some of those loads would be like 5%. So like if you put $100 in, $5, you're starting at $95. And why would someone sell those? They get paid that. It's a commission that you receive. And so a lot of times you see these on smaller accounts because their advisory fee that you're normally used to seeing with a firm like ours is not significant enough. So they want to put them in these funds that have a higher front charge, almost like a one and done transaction, right? To get paid again, they're going to have to sell you or make a change out of this fund to something else. So that's not the right process. That's not a good long-term strategy. Right.
So keep fees low, watch all these hidden fees. The best mutual funds just have the expense ratio, and that's it. Another important point about mutual funds is they're typically, the vast majority are dictated by asset class. They have an investment objective, and that's to follow a certain asset class. So there's a few that are called total return. If it's a total return fund, then they can do whatever they want. But for the most part, you shouldn't just be investing in one mutual fund unless it's specifically an all-in-one fund, like a target date fund. Most will be, hey, this is a U.S. large cap stock fund, or this is an international mid cap fund, or whatever. So you'll typically need several of these mutual funds to piece together to get proper diversification across the globe, like is what's academically reasonable for most people. So an easier way to do that is through what's called a balance fund or a target date fund, and those are kind of all-in-one solutions. But in most 401ks, you're just going to have kind of those pieces that for each asset class that have to be combined. For most of our 401k clients, we have our models built in that already do that for you according to our investment methodologies. So that's a useful way around that. But if you're doing it yourself, you'll need to get several most of the time. Within mutual funds, you want to be careful to look at the management style. You have index funds, which are passive, and most other funds which are considered active, where the manager is trying to be different to try to outperform. We prefer the passive, so that's why you see lots of index funds. You'll also DFA. Many of you may be familiar with them. We use them a lot. they're kind of a weird blend between the two. They're technically not active in the sense of being market timers. They're not trying to predict the future, but they're technically active in the sense they're not perfectly following an index. And so they're a weird gray area in between. So we like the pure indexing, and we like the DFA approach as well. We would typically recommend avoiding those active management styles in most cases.
Can I pause you right there, Sam? Because going back, that's a good point with the question about the hidden fees. So we talked about the pretty basic ones that you would always hear of: 12B1s, front end load, your normal fee for the year, your expense ratio. Maybe the question, I don't know if this is where they were going. I know there's a firm here in Utah that I've known some good friends there that they have a big story they like to tell about even deeper hidden fees in the mutual fund world, which is definitely the case, especially more on the active side where there's a lot of trading going on. So an additional cost that could be not represented fairly transparently would be the churning of the account. So making a lot of different trades in and out of different stocks or bonds has a cost associated with it. So those are pretty big trades going on, and there's a lot of big names involved, huge banks, Goldman Sachs, JP Morgan, all these big names you would have known that share in some of those costs. And so they build those into the funds. We don't see the same amount of hidden costs, not nearly the same. There's obviously going to be some trading going on with like a Vanguard and a DFA because they don't have the high volume. And so some of those are called soft dollar and hard dollar costs. So absolutely those are something to look out for, but those are much more on the more expensive, higher active trading funds, which are going to be close to 1 or 1.5% in fee. So you don't really have that same risk when you're dealing with a passive indexed type of mutual fund company like Vanguard.
Yep, absolutely. Let's actually move to what's the actual structure of mutual fund? How do they work? I think it's best viewed in the context of comparing them to ETFs. And you won't find ETFs in your 401k, but if you're reading in the financial world or you've got assets outside of your 401k, you're probably exposed or heard about ETFs. They're the other really big investment products. So on the next slide, Jake, the biggest difference between mutual funds and ETFs, and this is important to know, is that mutual funds are valued once a day. So if you put money into a mutual fund, you actually buy in at the end of the day after they tally up the total, it's called the net asset value of every asset held within the fund, and then divide it by the number of shares, and that's the price that you buy in at once a day. Okay. ETFs are valued in real time. So they are literally traded on a stock exchange functionally. And so their value will be trading second by second. When that means the advantage of that is, hey, if there's time in the middle of the day that you want to buy and not the end of the day, you can do that. The disadvantages of that are they can actually drift from their underlying valuation. So in mutual fund, you'll always get exactly the price that's the combined value of all those assets you're buying into, whereas ETFs are not that way. They can drift up or down from the underlying valuation. Now, the best ETFs don't ever drift much.
The highest volume, you're saying, like there's ETFs that have extreme amount of volume. A lot of people are buying and selling them, but they don't have a huge spread between what you sell it and what you would buy it for, which is what you look for.
And that's the bid-ask spread too. So there's the difference between net asset value and the price, which can drift. And there's also the bid-ask spread on an ETF, which is a real hidden cost with ETFs. And especially the lighter traded ETFs. I mean, if you're buying 100 shares and it's a 20-cent bid-ask spread, then you just paid $20 to in order to make that trade, and cost that you didn't know you were going into. So ETFs are typically, the average ETF is cheaper than the average mutual fund from an expense ratio standpoint. The reason for that most often, in an apples to apples comparison, is that whoever's sponsoring the ETF actually makes money as well as the market maker, because they're the one that you're buying and selling the ETF from. And so there's a lot of hidden fees in ETFs that the best mutual funds won't have hidden. So if you can avoid all those loads and 12B1 fees in mutual funds, those are easier to get rid of than this bid-ask spread that's always going to be a price embedded in ETFs.
And the mutual funds, because of that, they've, because of ETFs, actually mutual fund costs have come down drastically into where they're competing very close when you're looking at just expense ratio to expense ratio, but ETFs have that additional cost that could come up. So what maybe it thought of as like, this is way more cheap, this is a more efficient way for me to buy the index, might not be the case anymore. And that's where we lean as well, because we think mutual funds are a little bit, the fact they actually own the underlying the stocks and bonds gives us a little bit more, I think, security in the sense of we don't know what the market could hold. We didn't expect March to do what it did with COVID. So there's always going to be unknowns in the market, and holding the actual assets will definitely give us some sort of advantage over just kind of mimicking that, which is what an ETF really does, which is kind of hard to wrap your head around. I don't know if you want to explain that better than I did, Sam, but ETFs are a little bit of an interesting product that Wall Street came out with not even that long ago.
Yeah, no, ETFs are fairly new. And ultimately the advantage of ETFs is also their disadvantage in that because it's an exchange traded fund, when you buy a share of the ETF, there's no actually stocks and bonds being sold on the end. You still basically have ownership of those at the end of the day if that ETF company was to go under. But what that also means is you have that drift in that bid-ask spread. And I actually saw a question submitted that said, don't stocks also have that bid-ask spread issue? And the answer is absolutely. Anything traded on an exchange will have that bid-ask spread issue. So whether it's mutual funds or ETFs, each underlying security has a bid-ask spread. The extra fee that goes in on ETFs is that there's another layer of bid-ask spread on the ETF level itself. Whereas mutual funds, there's no bid-ask spread. You just buy in at net asset value. So ETFs, the reason that they've gotten so big is that in some cases they can be more tax efficient. So in a mutual fund, if you're to redeem, if you're basically getting out of the mutual fund, they have to sell something in order to give you that cash. And so that generates a capital gain or loss that is then distributed if there's not enough cash flow to meet that already from other, basically if there's not someone putting in money at the same time you're taking it out, then it creates a taxable event because they've got to sell something to give you your money. So in 2008, lots of people got big tax bills because so many people pulled their money out of mutual funds. Whereas ETFs, you sell it on the exchange, there's no underlying security that's being sold, and you take your money out and there's no tax impact that to everyone involved in the fund from one person pulling out. So
also the mutual funds manage those trades a lot different than maybe your retail investor on their own at E-Trade would do. They have, institutional trading platforms connected a lot closer to, they're able to do a lot more with their technology than you would on your own. So they're being strategic as far as handling those bid-ask spreads. They're not just putting huge limit orders in and buying thousands of shares of Apple without doing that in kind of a strategic way to prevent the price from just going crazy on them.
Right. Like we talked about earlier. Yeah. That scale that they have allows for better management of all those costs, including bid-ask spread, than you could on your own, like at an E-Trade kind of thing.
And we've both spent time at DFA's headquarters and actually toured and spent time on the floor where their traders are and learned all the philosophy, how they'd actually execute from a day to day. And it's pretty fascinating. It's very strategic, and there's a lot of thought that goes into that from a high level all the way down to the people pulling the trigger out to do the trade. So it's a lot more than you would ever imagine it goes into it. Obviously with billions and billions, trillions of dollars, it has to be. So a mutual fund kind of takes that whole effort away from you having to worry about how to put trades in, putting limit orders in, all those different things that can come with stress of being a trader yourself is kind of off your plate with a mutual fund, which is nice.
Yeah, absolutely. And ETFs are not a big vehicle in 401ks, as we talked about. And the reason why is their primary play is to be more tax efficient for the reasons I talked about a minute ago. In 401ks, you don't have to deal with those tax impacts. And so mutual funds have no bid-ask spread. They're typically more transparent in their fees if you're dealing in the mutual funds that you should. And so therefore mutual funds are what you're going to see in your retirement plan. We end up using even in our taxable accounts, primarily mutual funds rather than ETFs, because we're primarily using Dimensional and Vanguard, which are very good at handling the tax impact and typically have positive, especially DFA, has positive cash flows during even 2008 or March of this year, because DFA doesn't work retail. They only work through advisors and institutions. And so it's harder for people to panic and pull their money out and cause this kind of flight away from the fund that causes all this taxation. And so DFA ends up being their mutual funds end up being very tax efficient. And so we don't feel a huge need to use ETFs. Although in many instances in a taxable account, an ETF will be more tax efficient and give you the same exposure as a mutual fund and have some good advantages. But for most of the people that are watching this, that interact with us on a 401k level, you're going to see on mutual funds, and even on a private client level, we're primarily using mutual funds as well. Very specific ones that don't require the advantages that an ETF brings to the table. So that's the bulk. We're pushing up on our time, but I'm happy to field any questions, and Jake, of course, too, that anyone has. I would just, before we get to that, I'd just wrap up and say mutual funds have improved the average investor experience dramatically by creating that scale and diversification. But there's so many out there, and including so many bad ones. It takes a lot of expertise and forethought to determine the ones that will be best for each investor.
Yeah, and I'll even add to that saying one of the other benefits, and especially in a 401k, as you get started in a 401k, a lot of people start with just a few dollars, and so the mutual fund can take those dollars and stretch it across a variety of different asset classes and different companies, where they couldn't do that on their own. So those of you that are interested and like to do trading and kind of have it as something that is fun for them, and we have a lot of clients that are that way, we like to use mutual funds for the core investments to make sure that's what you're going to live off of. So in retirement, we're trying to accumulate money over our careers, right, for retirement. And we like to make sure that those assets that need to be used to live off of are very secure and thought through as far as how the allocation works. That doesn't mean you can't take a little money here and there and do some trading, say that you want to get involved with a company that you're excited about and it's fun for you to follow the news and trade. Like, definitely do that. And that's not something we do at our office, but we would definitely encourage you if that's something fun for you. We're not going to stop you, right? But be smart about it from a tax side of things, because the type of account you trade that in, whether it's an IRA or an individual account, will have different tax ramifications for you. And that's where you have to kind of pull that tax strategy in, where we can actually help add some value there for you. But this is, the more you spend understanding the market, the more that you get to know how this all works, I think is really helpful as you start to live off of this money one day. And that's just like anything in our lives. We come to big decisions like getting married, buying a house, buying a car. We have to learn a lot about it. Investing is one of those things that if you start early understanding it, you can be really, really make a big impact on your future, because you know what's going on. You don't just blindly trust that you have the best funds, because it may not be the case, So we spend a lot of time really analyzing the funds that go into the 401ks that we manage. And we narrowed that list down to 26 out of over 15,000 mutual funds in the whole market, right? So we don't take that lightly. And every quarter we review each of those and go through very strict criteria of 11 different things we look at. And fees is just one of them. So we look at performance, risk, how long they've been around, how big they are, a lot of different details. And so that hopefully gives you some sense of I guess, be happy that there's more going on behind the scenes than maybe you're aware of when it comes to your 401k investments and other investments you have. And mutual funds, there's even an extra layer of what the mutual fund manager is doing aside from what we do as a whole from representing you. So mutual funds are a great tool. I just looked up, Google's trading at $1,500. It's hard for someone to buy a lot of shares of Google, right? But if you buy, one share or you put $100 into a mutual fund, you can own some of that of Google or Apple or whatever company is probably going to be in that fund if it's in a large cap fund. So there's a lot of advantages. Mutual funds are a great tool, but you do have to be kind of head up and know what to look out for. So hopefully that's been helpful. Is there any other questions people have? I can stop sharing, I guess, now. Anyone want to ask? You can ask in person on video, or you can put it in the chat. You can always email us. So Sam at truenorthwealth.com and Jake at truenorthretire.com. We will definitely follow up with any questions you have. Where we love this stuff. If you couldn't tell, we could talk about it all day. We usually do.
Yeah. Great. Well, thanks everyone for tuning in and watching us later. We're honored to be able to help and serve all of you.
Thank you, everybody. We'll post this on our blog online and on our YouTube. So feel free to share it. We'll email it out too. Have a great day.